Last week we discussed about bond price sensitivity for the interest rates. So the measure that we use to measure that sensitivity is the modified duration, or the duration and modified duration. Is there any questions regarding that? How we can use modified duration to measure the interest rate sensitivity, and once we calculate it, how can we use or interpret the figure, and how can we use it to forecast the new price?
Mr. Shanta?
Yes.
Now, when we now let's say we purchase the bond on 1st of January 2021. So when we observe the sensitivity, it could be at a later date, no?
What do you mean?
In the sense, we bought the bond on 1st of January 2021. Can we look at the sensitivity? Normally we might end up looking at the sensitivity on a later date, like 1st of February. What the situation, right? So in that instance, when we are to take the price, we have to still pass the original price itself, is it?
No. So say if you measure the bond as at today,
yeah,
irrespective of the issue date, you have to price it today. It gives the instance picture. What is the sensitivity of the bond as at today? If you want to do it on a future date, you have to value the bond on for that future date and calculate the duration.
Okay.
But
So
generally, what we do to measure what is the current situation, what is the sensitivity, interest rate sensitivity of a particular bond as at now, we do the valuation as of now and use it.
Only thing is, originally on 1st of January, in my example, on 1st of January, if I had bought it for a yield of 5%,
it doesn't matter.
I don't know.
No. What is current yield? That means, sorry, what is the today's yield to maturity? What is the remaining maturity of that particular bond? That's what matters.
That's what matters. And to measure the MD duration, I might fluctuate the yield.
Yes, today's yield.
Yeah, today's yield up and down, and only observe the price difference.
Price difference. Yes.
Okay, thank you.
Say you bought it at 5% yield, but today yield is 5.05%. So you calculate the duration based on that, and interpret as what would happen if interest rate move from that 5.05 to 5.010 or 5 again back to 5% or something like that.
Okay, thank you.
Anything else? Is someone trying to ask a question? Or? Sorry, I cannot hear you properly.
Can't hear?
Not clear.
Macaulay duration.
Macaulay duration.
Yeah, what do we calculate the cash flow?
Sorry, you are not clear for us.
in that calculation, sir, what do we actually calculate? I didn't understand that.
Sorry, I
Can
couldn't.
you hear?
In the Macaulay duration,
So, what do we calculate? That the duration is the total cash flow is okay. Not the total cash flow.
not the total.
Okay. What do we calculate in there? Not the total cash flow, not the duration until we receive the total cash flow.
You mean, what does it mean by Macaulay duration? Oh,
Yeah, that means
yeah, it is a weighted average of time, because it's sort of average time to taken to receive cash flows in terms of present values. That's how it can be interpreted. That's how it's defined. But in practically, you don't get that much of meaning use of that Macaulay duration. That's why we use modified duration, because it gives you a proper practical definition, or where we can use it properly. In the Macaulay duration, it says weighted average time. So based on the present values of all the cash flows, what would be the average time taken to pay back the investor? But practically, by that time, it won't happen. However, with the duration, that is Macaulay duration, if it is high, definitely duration also, modified duration also high. So if Macaulay duration high, what does it mean? Interest rate sensitivity is high. For a small interest rate change, there can be large price change. That's what we can get from the Macaulay duration. But when it comes to modified duration, we can exactly quantify that amount to say that for a 1% change of the yield, this is the approximate percentage change in price. That's the difference. And again, as I mentioned towards the end, when we use this discrete time and discount cash flows at discrete on that discrete time interval basis, only we can see that difference, Macaulay duration and the modified duration. Otherwise, both are the same when we use the continuous compound. Anything else?
Excuse me, sir.
Yes.
The background windy noise is coming so badly. Maybe some fan or directed.
Yes.
I'm sorry. Sorry, sir. I'm sorry.
No, it's okay.
To tell you that.
We'll keep it. Now, what's the situation? Hello.
Now okay. Now okay.
Okay. Sorry about that.
Thank you. Thank you.
Anything else? Okay, if you don't have anything, shall I Continue. So last week we discussed about duration, and graphically I explained. So when we use modified duration to approximate the new price with the given yield change, that price comes. So that's this is the current price, current yield, or the prevailing yield in the market, yield to maturity, and that's the corresponding price. If we change yield, say, to Y2, actual price should be this P2. But when we use modified duration to calculate the new price, we'll end up somewhere here, P3, which is below the or lower than the actual price, because modified duration is a linear, it is a linear approximation. So we get some error. Even if we move towards the high interest rate side, or if we increase interest rate, still it would be the same. Remember, even we increase the interest rates, the price derived through duration would be lower than the actual price. What would it be? You can see here, this price is lower than the actual price, because the price yield relationship, this curve, always lies above this tangent line. So therefore, this is a key, a very important thing. Whatever the forecast or the new price that we derive using duration for a new yield, that new price would be always less than the actual price. So there's a error. So the other measure that we are going to discuss today, this convexity, is another measure that we can use to make a correction or try to fill up this gap. But again, it won't give you the exact answer, but it will take you to very close to the actual price. So in convexity, what we are going to do is try to measure this error and try to correct that. And remember, what do we have to do if we can measure this part or calculate this part? What do we have to do to the price that we calculated using duration? Always we have to add this part. This correction is always a positive correction. That means we have to add it to the price that we derive using duration. So this measure is called convexity. Indeed, it measures what is the curve or the size of this curvature. That means if you take another curve, it can be something like this. The curvature of the red line, what I drew now, is higher than what it was there. So through convexity, we are going to measure that curvature and make a correction to the price forecast that we are going to get using duration. So therefore, as I mentioned, convexity, this is a measure of the curvature in the relationship between price and bond yield. So this is the relationship between price and yield. Remember, this is not the yield curve. This is the relationship between price and yield. In other words, what does it measure? It measures the change in duration. So if we measure the duration at this point, it is different from the duration if we measure at this point. Why? The slope of the curve is high at this point. What about here? The slope is low. So the duration changes when the yield to maturity changes. When the yield to maturity decrease, what happened to the duration? Lower the duration. We discussed that. What are the three factors that affect duration? And what are the relationships? The relationship between duration and yield, this graph is the best to remember. Duration is the slope of this curve. So what would happen when yield goes down? What happens to the slope of this curve? What happened to the slope of this curve when duration decreases?
It increases, right?
Duration increases. This slope increases. So that means lower the yield to maturity, higher the duration. But higher the yield to maturity, lower the duration. What are the other two factors that affect duration?
Coupon and the maturity, sir.
Coupon and the maturity. Higher the maturity,
Higher the duration.
higher the duration. Higher the coupon, lower the duration. So you have to remember those, and intuitively you should be able to derive that. Yield and price, this would be the easiest way to remember. But maturity and coupon, it is better to go back to the equation. This equation. When the number of terms here, when the maturity increases, number of terms increases, and most of the cash flows are small at the before the maturity, you get bulk at the maturity. So duration moves towards that way. So this point moves to the right when the maturity increases. But what would happen when the coupon increases? These cash flows become large. Coupon payment becomes large. So weight assigned to cash flows increases. So therefore, this point move towards the left. So the duration decreases. That's what happened. So you have to remember that relationship and should be able to interpret. So what I wanted to say, so when yield changes, duration also changes. At what rate? That is measured through this convexity. What is the rate of change in duration in mathematical terms? This is the second derivative of price with respect to yield. Those who know about derivation, mathematical derivation, you know first derivative gives us the slope of the curve. Second derivative gives us the slope of the slope. That means what is the rate of change of the slope. So in layman language, remember it is the rate of change in duration. With the yield, at what rate the duration would change. When yield decreases, duration increases, and the convexity also increases because duration changes at a higher rate. Again, how to measure convexity? This equation gives you a way of measuring convexity. This is also a sort of approximate figure, but this is the simplest form. There are other equations that you can measure convexity with little bit more complicated calculation. I am not going to discuss that, but this will give you a better convexity because this is also widely used. So what are the terms? Again, as we measure the effective duration, here also what we are going to do, increase the yield and calculate what would be the bond price. If the yield increases by 10 basis points, what would be the new value of the new price of the bond? We decrease the yield by the same amount, then calculate the price of the bond. So those are the BV minus delta Y and BV plus delta Y. Plus delta Y means yield increase. Minus delta Y means yield decrease. Remember, but by the same amount. So what is BV naught? It is the current price. What is the price of the bond or the value of the bond at the prevailing yield? So these are the terms. So in the numerator, we have we calculate add the both price changes and minus 2 times current value divided by the current value and the square of the yield change. So then you get the convexity figure. So again, here if we want to calculate the convexity, what we have to do first, increase the yield a bit, maybe 25 basis points or 10 basis point or 50 basis point, calculate the new bond price, decrease the yield by the same amount as what we increase the yield to calculate the bond price, decrease the yield by the same amount, calculate the new bond price. So this figure should be lower than this figure. You know why? So it doesn't matter here because we are taking the sum of these new bond prices and we subtract 2 times the current or the present bond value. This everything divided by the current bond value into the change square of the change in yield. And remember here again, change in yield, it has to be in as a decimal figure, not as a percentage. It should be as a decimal figure. So again, what are the factors that would affect sensitivity and what is the consequences of higher convexity? When the convexity is high, the price volatility is high. Why? I mentioned earlier, the convexity means the curvature of this curve. When convexity increases, the curvature is high. So even for a small change in yield, you can see a high price sensitivity. So this is the graph 1, this is graph 2. You can see the price changes is much higher for the second bond, which is reflected in through graph 2. Price from originally at P1 to P2 and P1 to P4. P4 is higher than P2. For the same yield change, this is much change in price is high. So the same thing when it goes other way, price drop would be high. So that's why we said higher the convexity, higher the price volatility. For a small change in yield, price will change by a larger amount for a bond with high convexity. Then what are the factors that have impact on convexity is coupon. For low coupon security, the convexity is high. Remember, low coupon, high convexity. High coupon have lower convexity. What about maturity? So if you remember this graph, there are 3 bonds, but what are the differences? Coupon is the same, frequency of coupon payments are the same, but the maturity, bond A has a maturity of 20 years, bond B has a maturity of 10 years, and bond C has a maturity of 5 years. then you can see this is the bond A with the longest maturity. What do you see about what you can say about the convexity? If I denote it C A, convexity of bond A, C B and CC. What is the relationship? What is the relationship between these three convexities? Bond A has a 20-year maturity, bond B has 10-year maturity, bond C has a 5-year maturity. So all others are same coupon. Coupon is the same.
So convexity may be lower, higher
Which,
the maturity. A.
so what is this curve? Is it for bond A or bond B?
That is for bond A, no, sir?
It's bond A. This is for bond B. This is for bond C. Okay. Which one has the highest convexity? What does it mean by the convexity? The shape, that means the curvature. Higher the convexity, higher the, oh, indeed, other way around. When the curvature is high, convexity is high. Which one the curvature is high?
A.
A, yes. So you can see for even for a small yield change, price change is high. So bond A has the highest convexity, then bond B, and finally bond C. What does it mean? What is the relationship between maturity and convexity? Higher the maturity, higher the convexity. So because 20-year maturity, this is higher than 10, which is higher than 5. So high maturity, high convexity. So that's the relationship between maturity and convexity. Is it clear?
Yes, sir.
So in that maturity duration equation,
Sorry?
in macular duration equation, that coupon, if the coupon increases,
Coupon?
coupon increases, the duration should be increased, no, sir, not, no, according to that, if we take that coupon here, the equation,
So you are saying because of this coupon increases,
Yeah.
Macaulay, no, the thing is what we use this weights. Yes, don't get confused with that. These are the weights. So we give high weights for the for this timing. So therefore, this is shifted towards the left. If you go to these figures will be high. So there will be more weight towards this, and therefore this balancing point would move to the left. That's what happened. I think we did that calculation, no? With different coupons. Or otherwise, you can do that. Take the Excel sheet, put the same maturity, same yield, 3 or 4 bonds, but with different coupons. See what would happen.
I mean that when you look at that equation,
Yes. When you look at the equation, you feel like when the coupon is high, the duration is high. Yes, but you forgot something here. When the coupon is high, there's impact on this as well. That is price. Price also increases. That impact are also there.
you have to take that together.
Huh?
Not only the coupon you have to take, that means that
Basically, what happens, you see coupons here, but in this also coupons are included, which is hidden. So basically, you are misleading by looking at only these coupon payments. In this also, the coupon payments are there.
Right.
Yes. Slide.
60 WRT.
I cannot hear you.
60, slide 60.
16. 16.
Yeah. Next one
Sorry, this one.
is what is that WRT?
With respect to. You are referring to this WRT. This is with respect to. Sorry.
Okay.
So, anything else? So we can write here maturity convexity also. high the maturity, convexity also increases. So then we look into how we can incorporate that convexity effect and calculate the new price or the price change. So now remember, I mentioned that duration is a negative figure. Why? When interest rate increase, price decrease, or interest rate decrease, price increase. So the duration effect is negative. And remember, convexity effect is always positive. Convexity is always a positive number. So that's why we have this plus sign, and the convexity figure should be a plus figure. So therefore, that's another thing. This type of curvature, we call it positive convexity. In general case, this is the situation. In normal bonds, there are bonds that which may show other way around, but generally this is the situation. We call the convexities as positive convexity. Remember, this is a positive convexity. If the curve goes like this, then this is a negative convexity. But most of the bonds that we see behave in this manner. But there are bonds which behave, at least part of the yield ranges behaves like that. Then they show negative convexity. So that's why here we use always positive. It gives the positive effect. This part is what we discussed last week. What is the percentage change of the bond price due to duration effect? Due to duration effect, what is the percentage change of the bond price? Minus duration into delta y into 100. You may remember we did some examples. Modified duration delta y into 100. So it will take you to the new price of P3. This change as a percentage is measured through the first part of this equation. The second part measures the rest. Most of this, not exactly, most of this. So what is that part? Half of convex to square of the change in yield into 100. Again, remember, delta y, we entered it as a decimal, delta y even here as a decimal number. Then you get the percentage price change of the bond. This whole change from here to here as a percentage of the existing price. That's the figure we are getting when we use this equation. Remember that we get the percentage price change, not the price change. This as a relative figure as a percentage of the existing price. So we'll do a small example. A 15-year 7% option free bond. For the time being, don't worry about this. What does it mean by option free bond? Currently trading at par. What does it mean? What is the current price? What is the price of the bond?
So 100, no?
What is the price?
So 100.
Yes, price is 100. Why? How do you get it? Don't read this type of question and say the price is not given and the question is wrong.
So
Is
it
it?
is mentioned
Yes, it is.
currently trading
Yes.
at par.
Yeah, it specifically say trading at par. What does it mean? E naught current price equals 100. So you have to be careful. When you read things. Par means price is 100. Now it is asking to estimate the effect of 150 basis point increase and decrease on the bond price. What would be the effect if the yield changes by 150 basis point increase and decrease both sides? Do you expect the same amount of effect when the yield increases and when the yield decreases? Do you expect the same effect?
No, sir.
Yes or no?
Yes.
Yes. Why?
Because the price percentage change, we arrive at the price percentage change.
Yes, true. But
So it could be
would that change be the same for a yield increase and yield increase?
the percentage change will be the same, but you're talking about the what do you call it?
I'm talking about the percentage
The percentage change will be same.
change. Yes.
Either way.
Any other answers?
No, change won't be same.
Sorry?
Change won't be same.
Change?
It is not the same.
It's not the same. Why?
It is not a straight line.
It's not a straight line. If you go back, so this graph is a very interesting and very informative. So you can get a lot of things from this graph. Remember. So
that is happened due to the sensitivity, no?
due to this curvature.
Yeah, sensitivity.
Yes, altogether, yes, sensitivity. Say if this is, say, from y1 to y2 is a increase. So this is the total price change. You divide by P1 to get the percentage change. If we say roughly somewhere here, if we increase the yield by the same amount to get this Y3, what would be the new correct price? Somewhere here. Now the change is only this bit. In absolute terms, price change is two different figures, but the denominator is the same. Then as a percentage also, it should be two different figures. So the effect is not same when yield increases and when yield decreases. The effect is always high when yield decreases. When yield increases, effect is low. So remember that.
You mentioned that average can be positive, negative also. How that can happen?
Sorry, I didn't get that.
That you mentioned that average can be negative also. How that happen in some bond?
Convexity. I'll come to that. I'll come to that. So duration and convexity both given. If you want, you can try to calculate convexity using this equation. No need to change by 150 basis point in that case. Maybe 25 basis points plus and 25 basis points negative. Calculate the new prices and calculate the convexity. Then use that. It should come close to this. May not be exactly same because that depends on the yield change that you are taking. So however, duration and convexity is given in this instance. What is the percentage change in price when the yield decrease? Yield decrease, what is the percentage change in price? What is the duration? 9.115. Convexity 114.8. Remember, we have to use this minus sign in the duration. So duration is 9.5115. This is, even though I just call it duration, it is modified duration. Then what is this? This is change in yield. What is the change in yield? Now here we are talking about 150 basis point decrease. Change in yield. $150 basis point decrease. So how do you calculate the change? New yield minus old yield. So which one is high, Y1 or Y0? It doesn't matter what is Y0. We don't know Y0. It doesn't matter. We don't know what it is, but it doesn't matter. We need only the change. What matters is this change. But it's a yield decrease. Then which one is high, y1 or y0?
Why not?
Why?
Y0 is higher than y1. So then y1 minus y0, it should be
Negative answer.
negative answer. Minus 150 basis points. But remember, this is in basis points. What is a basis point? What is a basis point?
0.01
0.01
percent.
That's important. 0.01%. So when we convert this 150 basis points to a decimal place, it would be something wrong here, no? No. Okay, this is 150 basis points, no? Yes. When you convert it to a decimal, it becomes 0.015, and this 100 is there in the equation. So here you get the percentage change due to duration. Then you add the convexity part or effect from convexity. It is again equation half. What is this? This is convexity, and this is again change in yield to the power 2 and 100. Again same change in yield, there's no difference. 0.015 negative. But what would happen when you square it? Minus 0.015 to the power 2, this will give you a positive answer. So whether the change in yield is negative or positive, this part be a positive number. Therefore, all effect coming from convexity is a positive number. But in this case, duration is negative, change in yield is negative, price is going up. Negative into negative, it would become as a positive number. So positive number plus positive number, it will be a positive figure. So we get 14.964%. Remember, what we get through this equation is the change in price as a percentage of the current price. Is it clear? What did we do here? Use the equation to calculate the percentage change in price for a given change in yield, considering the convexity effect as well. Not only duration effect, considering duration effect and convexity effect, both. The convexity effect is always positive. But duration effect, it can be positive or negative. When the yield is decreased, that effect is positive. Duration is negative, yield change is negative. When you multiply those two, you get a positive answer. So price increase by almost 15%. That's what it says. Price increase by 15%. Then when it comes to the other situation, yield increased, what would happen? Same number of basis points. So same duration, same convexity. So what's the difference? Where do you get the difference? If you compare these two parts, there's no difference. Half 114.8 minus 0.015 to the power 2 into 100. So you get the same answer here. But the difference comes in the duration effect. When yield increased, price decreased. So the duration effect is negative at this point. You can see duration is negative, but the yield change is positive this time. So you get a negative figure here. Whatever the figure you got here, same amount, absolute value, but with a negative sign. So you subtract that answer from the convexity effect, you get minus 12.38. When yield increase, price decrease, but only by 12%. But by the when the price yield decreased by the same amount, price increased by 15%. So there's a approximately 3% difference between price increase and price decrease in terms of percentages. Is it clear? The key component here is this part, duration effect. Duration effect, it can be positive or negative depending on whether yield increase or decrease. If yield decrease, duration impact is positive, that means decrease, price increased. But when yield increased, price decreased, so the duration impact is negative. So therefore you won't get the same percentage change in price for a change in yield by the same amount. Even though the yield change is same, the percentage change in price increase and the price decrease would be two different amount. Always price increase is higher than the price decrease. That because of this conversion. So this is a very important relationship, this price yield relationship. Any question? Is it clear?
In this equation, essentially, we can't ignore the positive and negative figures, no? Just by
Yes.
the base, we can't
Exactly.
ignore.
Yes. When we calculate only the duration effect, we can ignore the signs and do the calculation. But in our mind, we know whether it's a increase or decrease.
Yeah, that is we have to judge that based on the yield and price inverse relationship.
Yes, we can do that. But when you put it into this equation, you have to consider, or you have to use with the signs. Otherwise, you will get a wrong answer. Especially when the scenario, yield increase scenario. Yield decrease once you drop these negative signs, you will get the same figure. There won't be any impact. But when the yield increase in scenario, if you don't consider this negative sign, then it will be a problem.
So excuse me.
Yes.
I have a question. When yield increase, this in this equation, not the duration part, In the other part, 0.015 is a minus. Why is that, sir?
Sorry. That's my mistake. It should be plus. Yes. Copy paste problems. This is plus. So this is should be plus.
Okay, sir. Right. Thank you.
It won't have any impact on the answer because once you scribe, you get a positive number. But yes, it should be positive because yield increased.
Mr. Nishanta, on slide number 16, can we do a simple example to arrive at the convexity figure?
Yes, we can do that. We'll go back to our Excel sheet. Can you see these numbers?
Not that clear, no?
Not that clear. Now?
Yeah, okay.
Now it's okay. Okay. So basically, to make it simple, I took a 2-year one with semi-annual coupons. Face value 100. Coupon is 7%. So how many cash flows? 2-year bond with semi-annual coupons. How many cash flows?
4 cash flows.
4 cash flows. So we have 1, 2, 3, 4 cash flows. Then we know face value is 100 at 7%. Coupon is 7%. Yield is 7%. Price is 100. We know that. So now what I did, consider a situation when the yield is 6.75. Calculate the price. Coupon payments would be 3.5.
Yeah,
Yield is
3.5.
6.75. These are the present values. So this is the price. 6.75. Price is 100.4605. It should be okay because yield is lower than the coupon. So it should be at a premium. We can just check by putting 7. You can see price is 100. So that's correct. Then what we need, this is the price when the yield decreased. Now we need another situation when the yield increased by the same amount. What would be the price? So from 7% to 7.25, 25 basis point increase, same cash flow. So you can see at this 7.25, these are the present values. Then you get the new price. Then what is the equation for the convexity? Can someone remember? Sum of these two prices minus 2 times original price divide by original price times what is the change in yield? 0.0025, what to the power here? Two new prices, add them together, minus 2 times the current price, divide by current price into the square of the current or the change in yield. Sorry, not current yield, yield to maturity. What is the change in yield? Oof.
Something to do with the brackets.
We'll put a bracket here as well. Yes, that's the problem. So we get 4.35. So I have done it already, but just to show you how to do that.
Okay.
Okay, here we consider only two. In our example, it's a 15 year. That's why convexity is much high. Duration is 9.1. Is it okay?
Yes, sir. Thank you.
Sir, can you show that Excel again?
So there's nothing new. Even so, no need to have this part. This is just to calculate the duration. You know how to calculate the price. Calculate the price at two different yields. One is when the yield decrease from the current yield, and the other one is when the yield increase from the current yield, but the change should be the same on both directions.
In this instance, since the price is 100, we consider the current yield as 7% itself, no?
Yes. Here we consider now the present yield to maturity is 7%. So yield to maturity 7%. So therefore price is 100. That's what we assume. So from 7%, 25 basis point increase and decrease. 7% to 7.25, 7% to 6.25.
Sir, in the example, do we take semi-annual or annual?
Yes, semi-annual. Frequency is 2.
No, not here in the example you have given. If we make that.
It's not given. I checked it. Yes, it's not given. However, in this example, you cannot calculate these because the yield is not given. No, sorry. The price is at par, so the yield is 7%. Then you should be able to calculate all those things. Only thing is, you can try with annual coupons and semi-annual coupons and see whether you get this.
So when you say 7% option free bond, 7% means coupon
Okay.
rate.
As I mentioned earlier, forget about this option free story for the time being. This is for the completion, and to avoid any confusion, 7%, when you say consider 15-year 7% bond, so not the option free, we'll delete 7% bond. What does it mean by this 7%? That's the question. What is this 7%?
Coupon rate.
This is the coupon rate. This is coupon rate. It's not the yield, but how do you get the yield? Because it says trading at par. When you trading at par, yield equals the coupon rate. Okay, shall I move forward? Sorry, in the same example in this Excel, you can see something called ED. What is this? This is effective duration. Can you remember we discussed something? Effective duration. Change the yield by a small amount plus minus, calculate the new bond prices, and you can calculate the duration using this equation. Here, this is that calculation. You can see E58. E58, this should be the high price. That means when the yield decrease. So this is the price here, E58 minus H58. That's the new price when yield increase, 99.54. Divide by 2 times change in yield into 100. So the duration comes as 1.83. You can see modified duration using the our equation, basic equation. Still you get 1.83, very close to this. So then I'll move forward to show you when you can see negative convexity. The convexity that we discussed so far, we call it a positive convexity. This shape is having a positive convexity.
Sir,
Yes.
in that example, do we need that trading advice required since we take the change?
So sorry, I didn't get that. Do we have to?
Do we need the information that is trading at par since it is we take the percentage change only?
Yeah, yes. Trading at par. Without that, how do you calculate? How do you calculate the sorry, not you are referring in this example, this one?
Yes.
Yes, no need. What we need, duration and convexity. If you have to calculate duration and convexity, you need this trading net par.
No, since we take a difference, that means taking difference, no, it will increase and
No,
decrease.
yes. Since we are considering only the percentage price, sorry, percentage change in price, we get it here. We don't know. We have not used whether the current price is par or something else, but we have considered duration figure and the convexity figure.
Apart from the yield change.
Apart from the yield change, yes. So,
Only those three is enough, no?
These three is enough. Are enough, yes. What is the yield change? What is the duration? What is the convexity? That's enough. But the thing is, indeed, so I have given these two. If I have not given these two, you have to go back and calculate the duration and convexity. Then you need this.
No, sir. I mean that in this, to calculate this duration and convexity, we are taking a change in only the change. No, so what we not, it is not required to take only 100. We can take another amount, no? Any
Yes,
amount?
then the duration and convexity would be different.
Is that,
If you calculate this, say now I calculate at 6.75 and 7.25 because we assume now the yield to maturity is 7% and the bond is trading at par. So I increase the yield by 25 basis point and I decrease the yield by 25 basis point. So this is the convexity and this is the duration. Assume instead of 6.75 I use 5.75 and 6.25. You can see the convexity.
no, sir. I mean the change. That means not SP value 100. Without taking 100, can we take another amount to 100, 200 or something like that? It will give the same answer.
Without
Taking 100, if we take some other amount like 200 or something like that, it will give the same answer.
what do you mean? So here that's what happened. Now I am not considering the price as 100. Now the yield is 6%. That's what I'm thinking now. Then the price would be at 6%. Price is 101.8585. 101.8585. Now the yield to maturity is 6. Current price is 101.8585. And I'm doing the 25 basis point change plus and minus. Now the convexity is this.
No, sir, I mean not the price but the face value. 100, if we take
Face value. Face value, yes.
if we
No.
take
If you don't take this face value is yes. Then so if you put 1,000, same thing. Face value it won't matter because ultimately this gives us a the price would change. That's fine, but the convexity and the modified duration comes in that same modified duration, especially is sort of a percentage. You can say it won't change whether you use 100,000 or even 1 million. It's the same.
okay.
Anything else? Simply to for the duration and convexity, what does it matters, or what are the factors that we need is the yield. So yield and the coupon rate. So when you put it into that equation, whatever the face value, you should get the same duration figure, because it gives the percentage change in price. Whether the price is 100, face value is 100 or 1 million or maybe 1,500 or something like that, it doesn't matter. Yes. Anything else? Shall I move forward to this? Okay. In the previous example, the option free, that word is there. What are the options available in bonds? If you can remember, I discussed callable bonds and puttable bonds. So those are the options available with bonds. Basically, there can be some other type of options, especially like mortgage-backed securities. You can pay back the principal early, maybe part payment or something like that. So those options are available with bonds, especially in a callable bond. When the at some point, issuer can redeem the bond, pay the investors, and buy back the bond. Those are called callable bond. What would happen when yield decreases? Generally, price increase. But for a callable bond, there's a price called call price, at which price the issuer of the bond can purchase that bond. So when that option is available for the issuer, no one would buy it at a higher price than the call price, because issuer may buy it at the call price. If you have paid more than that, you are losing. So the price of a callable bond won't increase when yield decreases, in the same way of a option free bond, plain vanilla bond. So this is the price yield relationship this is the price yield relationship for a plain vanilla bond, and this is the relationship of the price and yield for a callable bond. When yield decrease, price increase, but at a slower pace. So this part is of the curve is showing negative convexity. When the convexity is negative, we cannot use the previous equation. That's why, to avoid that confusion, this says option free bond. If there's any option, then you can't do this. Even for a callable bond, we don't calculate the yield to maturity. We calculate effective duration. And we calculate yield to call. That means what is the call date, on which date the issuer can call it. We calculate only up to that date. Yield is calculated assuming that the bond will available in the market only up to that call date. So it's called, yes.
Yeah, so when the issuer calls for it, the purchase person, the buyer has to like honor that, or is there
Yes.
option they cannot?
No. There's no option to the buyer. The option is available with the seller.
Issuer. Okay.
Whenever he calls, the buyer's obligation is to give it back and take cash.
Okay.
If you don't give it, you won't get anything, and
Okay.
that's it.
Thanks.
Practically, Ms. Nanta, how does it work? Like, are there any different like callable bonds and normal traded bonds? Will there be any different in the coupon rates or anything?
Coupon rates may be, yes, because to attract the investors, that can happen, or it may be the same coupon rate. If it is the same coupon rate, it may get adjusted through the yield or somewhere. That will happen, but practically what would happen on the issue date, the call schedule is given. Not only so this is an example of a callable bond. Maybe this is, yes, you can see call 7. The maturity date is July 13, 2037. Can you see this?
Yeah.
The maturity date is 2037 July 13, but there's a call option. Call on July 13, 2015 at par. So the issuer has the right to call it on this date at this price. So even the yield goes to 2%, 3%, price won't go above par when it near this date. And the other thing is, this is the first call date. In the next slide, it shows same issue. Call frequency annual, callable only on dates on. So this is we call call schedule. So first call date is July 13, 2015. Then if the issuer does not call the bond on this date, he cannot call until 2016. Only annually, on this date only, he can do that. And again, after 2025, no, I think if you scroll there, there may be until 2036 last call date.
It seems to be the coupon only. He can call back on coupon due dates, no?
Only on, yes, on coupon due dates.
Coupon due dates, and at that point, when it's basically callable bond is basically buying back the bond, no?
Sorry, callable bond
will be basically the issuer is buying back.
Yes.
Buying back. So in that graph, as you explained, now let's say I bought it on. Yeah.
So say the first coupon date was July 13, 2015. No? Say maybe after July 13, 2014, even the yield decreases, price may not increase like this way. It will be something like this, and the callable call price is 100. The price won't go above 100. It will be, it moves like something like this. On the near callable, the very near to the call date, it would be somewhere here close to par. If it is after or very near 15th, sorry, July 13th, 2015. After that, definitely, when the yield goes down and the price should go above 100, it won't happen. But if the price is somewhere 90s, it will go down on the same manner. But if the yield is low enough, the price to go above par, it won't happen after or near July 13th of 2015 and after that. Because there's a chance next callable date, the issuer will pay par and get back the bond. Is it clear?
Yeah, sure.
Somewhere, what is the issue date of this bond? This was originally issued in 2007. So maybe until 2014, somewhere like that, it will behave as a normal bond because the issuer cannot
Recall.
call it, but still there's uncertainty. So therefore, still it may not go above par. Even in 2008, say the yield remains very low and you buy it at a premium and the situation prevail until 2015, what would happen? Then the price should come down to par. So therefore, the chances of going above par is low. And everybody will calculate the price assuming that the bond will be there only until this call date.
Until 2015.
Out of the 2015, yes. They will price it in that manner because there's a risk that the issuer may call it. So when you price a callable bond, you cannot use the equation that we used here because there's an option embedded into the bond. You have to calculate that premium. It's like a pricing of an option.
So you can't decide on the maturity, right?
Yes.
Okay.
Not sure. There's a uncertainty there depending on the yield prevail at that time.
Sir, even though price cannot go beyond the par, it can go down, no? The price.
Yes. If it is going down, it will behave like a normal bond. If the yield is to increase, price will go down in the normal manner. That's why only part of the curve behave with negative convexity. Other part would be with positive convexity.
So, yeah. So even though this is like going up to 2037, so this will obviously behave like a short-term one, right? Because it's like every other year, every year you are
Yeah,
closing.
yes, that can happen. Yes.
Okay.
It's still again if the say now the bond is issued at 6.7 something, if the yield was around 8% or something, then it's somewhere here. So then it will may behave on the same manner, but when it get very closer to or say a bond is issued at 6 point, coupon is 6.335. So you issuer may not buy it back when the yield is maybe 5.7 because he's issuing cost, and whenever issuer buy it back, he has to raise funds from another new issue. Once he consider all the cost of that new issue, there may not be a
Enough.
net
Yeah.
gain. Then he won't do that. So therefore, the market has
So the
to
market will know that and behave.
that, and yes, depending on that break-even point, this move will happen. So this would be that sort of break-even. The market knows if the yield goes that below this point only, the issuer may call it or something like that. Then bond will start to behave like that.
Okay, thank you, sir.
In Sri Lanka, are there callable bonds?
No, as far as I know. No government bonds for sure. I don't know whether
Debentures could be,
there may be debentures. Yes.
This is basically issuer. This is, I think, this will be also applicable for long-term maturity bonds because considering the interest rate fluctuation. No?
No. Yes, it may be a long-term bond or yes, very short-term bonds. They may not use this because no point for a 2-3 year bond unless you expect drastic change in yield. Basically, medium to long term bonds, they use this option. Yes.
Sir, in which type of bonds are used usually?
The basically if issuer things like this was issued in 2007 and for a 30-year, it's a 30-year bond. So it's a long time and anything can happen. Issuer wants to get the advantage whenever the yield goes down. If he can refinance his position at a lower cost, he wants to keep that option available with the issuer. So in such instances, uh, they might go to the market with this option. I think so. For this KFW, now they are on top of it now. 6.25 or 6.3325 coupon versus what is current price or the current yield for another 12 years or 17 years. Now they may be able to buy borrow at maybe 2-3%. They should have called it by now. They can get the advantage of low yield without paying at 6.335 for another 12 years. If they can pay this back and borrow the same amount at 2%, they are saving 4% annually. Even saving 2-3% is huge. No? Okay, is it clear?
Okay, sir. That the buyout of the bond doesn't have no option, but the issue has the option to call.
In the callable bond issue has the option. In the puttable bond, that option is available with the buyer. When the interest rate goes high, the buyer can give it back to the issuer and get their money back. But again, there will be a schedule like this, on which date that you can do that. This is called call schedule. There should be a put schedule for a puttable bond. Clear?
Okay, sir. On that schedule, definitely the only those days only that
They can call it, yes. In between these days, they cannot do it. If they call it on if they didn't call it on July 13, 2015, then they have to wait until July 13, 2016.
Okay, sir. Thank you.
So far we discussed about how to measure the interest rate sensitivity of a single bond, whether its duration and convexity or the combination. It is for the single bond, but you may have a portfolio of bonds. That means collection of bonds. Then there's a total value. Then what would be the change in that value for a change in yield? One way you can do that is you can calculate the change in value for each and every bond and add them up to get the change in value of the total portfolio. But you don't want to do that. You can calculate the duration of the total portfolio and calculate the convexity of the portfolio. Both are very simple. You know the weighted average concept. So the duration of the portfolio is the weighted average of duration of individual bonds. Convexity also the same, weighted average of convexities. So what is WJ is the weight of each bond. DJ is the duration. Here, weight of the bond and the convexity of the bond. I think there was an example in this Excel. Say there are 5 bonds in your portfolio. These are the market's values. These are the duration of each bond. These are the convexities. Then what you have to do? Calculate the weight of each bond. What is the weight assigned to the bond? One is the total market value is 9 million. Only 990,000 is invested in bond one. What is the proportionate? That's the weight for the first bond. Market value of that particular bond divided by the market value of the total portfolio. Likewise, for all bonds, you can calculate these weights. So sum of these weights should be 100. Then to calculate the duration of the portfolio, what do? Multiply the duration by its corresponding weight. This is here. Multiply the duration by the corresponding weight. So do it for each and every bond and take the total. This gives you 5.5 duration. So the duration of the portfolio of these 5 bonds is 5.5. Same thing here in the convexity. Convexity multiplied by the weight. Convexity multiplied by the weight for each bond and add them together. You get the convexity of the portfolio. So now if you want to calculate what would be the percentage change price or the percentage change of the market value of this bond portfolio, you can use this duration figure and this convexity figure as we did in the for a single bond. Now you can consider the whole as a single bond with this duration and with this convexity. The concepts would be the same. So what does it mean? If the interest rate increased by 1%, value of this portfolio would decrease by approximately by 5.5%. It would be slightly less than that once you adjust it for the convexity. Clear? So what I explain here, what does it mean by these two equations? How to calculate the duration of a portfolio and how to calculate the duration of, convexity of a portfolio. Once you get it, you can use this equation to calculate the percentage change in value of the total portfolio. Any question? Any questions? So if you don't have any questions, before we can move into the next handout. So I'll start with the primary bond markets. So before we move into this, we'll take a break. Is that okay? Or you have any questions? If you don't have any questions, we'll take a break.
Sure, sir. Yeah.
Yes.
So I have a question that in portfolio duration and convexity questions in that Excel sheet, that market price of the bond means the price of the bond. Market.
Yes. What is the price of the bond at the market rates?
Then we have to calculate the Macaulay duration and the modified duration.
Yes, based on the prevailing yield to maturity in the market, we calculate the price, we calculate the duration, and we calculate the convexity.
To calculate duration, that we have to take that Macaulay and then modified. We have to calculate.
Yes. Basically, we get the modified duration and do this.
I have another question. What is the use of effective duration?
Effective durations? Yes, that's a good question. So like bonds, like callable bonds, we calculate the effective duration because we cannot calculate it or the duration considered in the cash flows until maturity. We assume the bond will be called on the callable date, and on that date we get the cash flow at 100. Then in that case, what would be the duration? That is effective duration. So, but if you consider, say in this example, you can see effective duration is almost Macaulay, sorry, modified duration, because in this case we consider all for cash flows. If you think this bond will be call after 1 year, then you just put 103.5 here and no cash flows here. Then say now you can see convexity is negative. Sorry, no, it won't work because this I didn't change. However, the duration, this is Macaulay duration changes. Effective duration. To make it clear, we have to use this here. So now the effective duration is only 0.94, but the modified duration should be what it was there, 1.89 something, because when we calculate the modified duration, we consider all cash flows. In the effective duration, like we are assuming here, it's only up to 2 years. Sorry, only 1 year. Then the bond will be called. Then we calculate price it like this, not exactly. That's the difference.
And usually this is used for callable options, callable bonds.
Sorry?
This effective rate is effective duration is used for that callable bonds.
Generally, yes, with some embedded options, bonds with some embedded options. Maybe callable bond, or there are other bonds like mortgage-backed securities, things like that.
Okay.
Because the cash flows may vary. It may not follow exactly the until maturity, exactly the way we expect.
Okay.
Any other question? So if you don't have any question, shall I start this about the primary bond markets? What's the primary bond? Primary market is wherever new instrument is issued. That's the primary market. It can be a bond, it can be a bill or a share, commercial paper, debenture, whatever. When it issues for the first time, that is we call primary market. That issuance may be from government, for corporates, or in some countries maybe municipal councils or state governments. Can be any issuer, practically. So why do they do this? To get new capital. So all the proceeds will go to the issuer. In the primary market, whatever the cash flow coming from investors, it will go to the issuer. So the objective of issuing securities in the primary market is to raise capital by the issuer. So that's we discussed about primary and secondary market at the beginning of this course. So basically that's the idea behind that, where we create new assets. That's the primary market. Issuers will issue financial instruments for the very first time. So even though there are stocks, we are not going to discuss about primary market. We mostly discuss about fixed income securities like bonds and debentures. So as I mentioned, primary market is the place where we issue the bond for the very first time and distribute it among the investors. Then only it will start to trade among investors. That becomes the secondary market. The primary market is between issuer and the investor. So generally in a new bond issue, there are four phases. First one is announcement. Whenever you are going to issue a new bond, it will be announced to the market. Even in our government bond issuance, you see prior to the bond auction date, there will be a press release. That's the announcement. Then on the auction date, this pricing is happening. It's not all bonds are issued through auctions. However, this pricing is happening after the announcement on a particular date. The pricing is taken place. Then whoever who got the bonds will be distributed among those parties, and payments will be received, and for the supporting institutions in the bond of in this process, they will be paid for their services. Those are the key things in a new bond issue. But for some there won't be any payments for other third parties, but in some cases it will be there. So in the current market, in the global, three main types of issuing bonds. The first one is the privately negotiated public bond deals, and the second one private placements of non-public debt issues. This one is the first one is privately negotiated but public bond deals. The second one is private placements, and not only that, it's a non-public. Then the third one is the public auctions. So first one, privately negotiated public bonds, most of the time corporates and financial institutions they do this, but basically negotiation between the issuer and the on behalf of the issuer and the investors are done by financial institutions, maybe an investment bank. The bank negotiates with the possible buyers of the bond on behalf of the issuing corporate. But this is open for wide spectrum of investors. In the second one, and once the bond is issued, it can be traded in the secondary market. But in the second one, private placements for non-public debt issues, the issuer, again maybe through a financial institution, find out some major investors, mostly just like pension funds or insurance companies, things like that, investors in that type of, have a discussion or negotiation with those parties and place the debt with those parties, those who agree with in the terms. The key here is it is non-public. Those are not tradable in the secondary market. Whoever who bought the bond has to keep it until maturity. So those are the private placements. Then the public auctions, mostly used by government securities because they want to maintain the transparency, because these are public funds. So government securities issued through public auctions. The announcement will be there, then bidders can submit their, then the issuer will go through the procedure and select who are the winning bidders. Even in a privately negotiated public bond deals, same sort of things would happen, but there's a possibility of negotiation here in the privately negotiated public bonds. In the public auctions, there's no possibility of negotiation. Either you accept the quoted price or reject it. But in the negotiated ones, you can negotiate and come to an agreement on the pricing of the bond. So these are the three main types nowadays used by in the market participants when they are issuing bonds. So what does it mean by pricing of a bond? So that is, again, that's a sort of bargaining between issuer and the other parties who helps to complete this transaction, including the investors. So all the terms and conditions are agreed between the issuer, the financial institution, and lead managers, means the parties, those who are helping the issuer to issue this bond and sell them to the investors. So investors, lead managers, financial institutions, the issuer, they'll discuss and decide the terms of the bond, including the price, not only price, the fees to these lead managers and the other financial institutions. So that is we call pricing. So in that pricing, what are the terms that we may agree? Coupon rate, what would be the coupon rate? And the spread, that means if it is sort of a floating rate bond, what would be the spread against the benchmark rate, or the issue price, what at what price this new bond is going to be issued. That means this is the current this decides the yield of the bond, and what are the fees to be paid to the lead managers and other financial institutions, those who engage in the process, including this management group. So that is meant by pricing. When we do that,
we missed that slide 3 and 4, no?
Oh no, we discuss. This is 3. This is 4.
All right. Okay. Sorry.
Oh. So in most of the time when the corporate bonds are issued, public corporate bonds, financial institutions like investment banks, they comes to the middle between the investor and the corporate or the issuer, because corporates, they don't have much knowledge on the markets. What is the appetite of the market, what are the yield forecast or the interest rate outlook, possible investors. Corporate, they don't have that information. On the other hand, investors, they don't know about this corporate or the issuer. They don't have the capacity to evaluate the financial statements or the business of this corporate. So bridge that gap, that investment bank or the lead managers, we call them, comes into the picture. Issuer will hire a lead manager to formulate the borrowing plan and decide the terms and conditions which is suitable for the borrower as well as the investor. If the lead manager prepare this in favor of investors, then it's not good for the borrower. He may not go with that investment bank. The borrower will go to another investment bank and ask to do this. On the other hand, if the investment bank or this lead managers, they structure this product or this transaction, this deal in favor of the borrower, it is not good for the investors. Then investors won't come and invest. The main target of the investment bank is to get their income. So they are try to have a balance and move forward and be a success issue. When the issue is success for both parties, for the borrower and the investor, when it becomes a fair transaction, then the other borrowers, they will tend to go with the same investment bank or the lead manager because they know the transaction is fairly priced. On the other hand, investors also tend to buy the new bonds which are coming through that investment bank. So therefore, investment bank, their main target is to get their income as a commission. So they don't worry about the it mostly not depend on the issue price or the terms of the conditions. So therefore they will try to strike a balance between investor as well as the borrower. Otherwise, they will lose the transaction deal. So their income. So in the public corporate bonds, the investment bank, or we call lead manager, plays a major role. That financial institution mean that lead manager. They will negotiate the coupon, what are the fees for them, book runners and lead marketing groups, what are the fees that they are going to charge for the bond issue. All those things will be negotiated with the borrower by the investment bank or the lead manager. And the price will be negotiated with the investors as well. Okay, they will discuss, oh, these are the future prospects of this firm, they have the paying capacity, they will, or their profit would be this much, so therefore they have the repayment capacity. Though there's no direct link between profit and the payments on a bond, but the investors want to know whether the borrower is in a position to pay its liabilities. So whatever the future prospects would be, or is a concern to the investors. So what investment bank does it, they analyze the company and come up with their borrowing cost and suggest a price and discuss with the investors as well with what is the suitability of this investment for that investor and things like that. With that, they'll try to come to a conclusion on the price. So, but there in a private corporate bonds, there can be different sort of transactions. One we call board deals. So in a board deal, what the investment or the lead manager does, the lead manager purchase the whole issue from the issuer. The lead manager purchase the issue. If it is 10 billion worth of issue, whatever the agreed price, say only face value is 10 billion, the price agreed is only 9.5 million. 9.5 billion, sorry, if the issue face value is 10 billion, agreed price is only 9.5 billion, the lead manager will pay 9.5 billion to the issuer and get all these bonds. Then lead manager will try to sell it in the market at a higher price. That is called a board deal. So therefore, in that instance, the lead manager gets the negotiated difference between the proceeds paid to the borrower and the initial issue price, regardless of any fee schedules. So he bought it at 9.5 billion. If the lead manager can sell it and earn a 9.8 billion, that would be its income. So that's a that's a very common method, but now it's gradually in a decreasing trend. The lead managers tend to go for a fee basis one without taking any risk. In a board deal, the lead manager takes a risk, because if the lead manager couldn't sell it at a higher price in the market for the issuers, the lead manager makes a loss. So therefore, they are not going to do that very often. They try to fix the fees and get the fees from the issuer, irrespective of the price issued, the price of the bond. But they will try to sell it to investors as much as possible.
So this happens when the bonds are not sold also in the market. Also, they have to go buy that.
Sorry, I didn't hear that.
I mean, like issued bonds are not sold in the market, the lead manager has to buy those, no? Under underwriting.
Not in every instance. That depends on the agreement between the lead manager and the issuer. So basically, in a board deal, that happens. The lead manager is required to buy whatever the unsold amount. But if it is not the agreement, there's no such requirement. requirement. If it is the best effort method, the lead managers try their best to sell the bond. Whatever the successful amount will be sold to the investors, others will remain.
It is not always the case.
It's not always the case, yes. That depends.
Please, in the board deals, in case of board deals,
In the board deals, the price is agreed between the lead manager and the issuer. Lead manager will purchase the whole issue, paying that price. Then the lead manager will sell it in the market to the other investors at a different price. That difference is the lead manager's income.
okay.
The thing is, public bonds, you have to comply with some regulations. You have to register this, maybe in a Securities Exchange Commission, or maybe a exchange in a country where bonds are tradable, and you may have to obtain credit ratings, things like that. So there's a burden for the borrower and additional cost. There will be a registration fee, registration cost. You have to prepare a lot of legal documents and a lot of documentary works there. Most of them will be done by the lead managers and co-lead managers, but there will be a cost, and you have to get a credit rating, at least maybe from one rating agencies. For that also the borrower has to pay, and takes time. So there's a significant burden to the borrower when they are going to do a public bond issue. So the second option, private placements, there's no such a requirement. So there's a saving on that. On a private placement, what the procedure is, what is the procedure? As I mentioned earlier, issuer through a lead manager or a sort of financial institution scan the market and find out who are the possible investors of this bond. Then they'll approach them individually without publicly announcing that to the market. They'll approach these possible investors individually and try to make a deal between two parties. If the issuer and the investor agrees, then the issuer will borrow from the investor on the terms and conditions that they agree. Since it's not a publicly issued one, the issue is not publicly traded. In private placements, liquidity, there's no liquidity. Investor cannot sell it to another investor in the public market. Again, there may be a possibility to have a bargaining at the private level and transfer the ownership to that party. The important thing is, in a private placement, no registration is required, maybe no credit rating is required, but it will give a yield enhancement for the investor. The cost is maybe somewhat high in a private placement compared to a public placements, but without considering these costs. these registration fees, credit ratings. When we include these costs, going public would be more costlier than placing a private placement from the borrower's point of view. From the investor's point of view, what they get through the public issue may be less than what they get through the private placement, because there's no liquidity. They will get a compensation for that, things like that. So therefore, there will be offer for the yield enhancement for the issuer as well. So issuer and the investor both will have the advantage, but as it says, there's no free lunch, so there will be some cost to both parties. So from the investor's point of view, the major concern is illiquidity. The bond cannot be traded in the secondary market, but it will offer you a yield enhancement. If you can hold it until maturity and you assume that the issuer will honor its obligation, then it would be a good transaction. So mostly these type of transactions are entered with like pension funds, insurance companies, like that, institutional investors with long-term investment horizons, because they can hold it for a long period, and they don't want to trade it, but they want to earn the interest income. So that sort of investors will attract this sort of funds mostly. So the third type of bond issuance is the bond auctions. Okay, before I move into this bond auctions, so even Sri Lanka or countries like us, we issue two types of government bonds. One is in the domestic market and denominated in rupees. Indeed, not two, we can say three at least. However, major portion is in rupees in the domestic market, rupee denominated government bonds. Those are issued through these bond auctions. The second one is Sri Lankan development bonds. Again, for the Sri Lankan investors, or the issue is issued in the domestic market, but only thing is denominated currency is dollars. That it is also issued in following this bond auctions, this method, that what we are going to discuss. But the third category, that is the international sovereign bonds, that government issuing bonds in the international markets in foreign currencies. For those we don't follow, or not any country follow this bond auctions method, but it basically sort of a public corporate bond, or this first type of privately negotiated public bond deals. This type of process will be followed. So when we issue international sovereign bonds, first thing we do, we appoint lead managers and co-lead managers and the book runner. One of the lead managers become the book runner. There may be more than one lead manager, because different investment banks have strong presence in different regions of the world. Who is very strong, who is having access to investors in Asia, they may not have strong presence in and so we need a party from America or the Europe or UK, something like that. So we'll select few lead managers, then we have to go through these processes, registration, get the legal approval from US or other countries, and we'll have to get the credit ratings from rating agencies, list this in a stock, one or more stock market. We do all those things when we issue international sovereign bonds. Then the lead managers, they will analyze the issue, and the government and the country situation or the position, then and the international market, what are the risk appetite of investors, things like that. What is the willingness of those investors to invest in a foreign currency bond issued by Sri Lankan government bonds? They will analyze all those things and come up with a pricing range. Basically, the bond will be priced in this, say, in terms of yield, say 5 to 6% or something like that. So they give a price guidance. Then they issue that if the issuer, that means Sri Lanka, government of Sri Lanka agrees to that, then they will announce it to the possible investors. Then the investors can think about it, and investors can submit their bids or their willingness. Okay, I can buy 500 million or 100 million, things like that, and the price. Then with the demand, issue manager will tighten the price range, and the window we keep it as a window. It may kept open for maybe 2-3 days. The investors can submit their bids. So on the last day, depending on the demand from the investors, the lead manager will decide, okay, this is the price and this is the amount we borrowed. So that's how it works. So basically we follow this public corporate bonds issue mechanism when we are issuing international sovereign bonds. This is the very common method used by even other countries. Only very only countries with very sophisticated markets, they will directly announce by themselves, even in a foreign currency, and do an auction, because investors, they don't worry about them, and they know about those countries. No need to go through, and investors are happy to invest and willing to invest in those countries. So therefore they can straight away go for these bond options, even for foreign currency issues. But say if you take America, USA, they don't issue bonds in any other currencies. They just issue bonds in dollars, because that's the cheapest way of funding for them. So dollar bonds issued by US government, that's the risk-free asset in the global market. That's what global market thinks. So that is the cheapest way of funding. They are not going to issue in sterling, pound or euro. If they want, they will convert that dollars into whatever the currency they need. But there are countries like us, developing countries, they have to issue bonds in foreign currencies for whatever reason. Then they'll have to follow the procedure like a corporate. So that's about issuance of international sovereign bonds. Now I'll move into bond auctions in generally,
Sir, I
how
have a question.
we issue or we conduct auctions. Yes.
No, Sri Lankan development bond also the same case, they followed the
Sri Lankan development bonds, we are having auctions.
central bank do issue them.
Yes.
Okay.
So what is the salient features of Sri Lankan development bonds? What is the difference?
Basically, it's denominated in dollars. That's the key. And now it's nowadays tendency is to go for a fixed coupon bonds, but earlier it was not like that. It was a floating rate. It issued as a floating rate issue linked to benchmark, LIBOR benchmark. Say LIBOR 6 month plus a margin. So every 6 months, when the LIBOR changes, coupon rate changes for the coupon rate applicable for the next 6 months will be changed. Those are the key features or salient features of Sri Lankan development bonds. But now, since we have a problem with LIBOR, it's going they are going to abandon it. So since we have a problem of the benchmark rate in absence of LIBOR, what would be the appropriate benchmark index? So we have that doubt. So to avoid that, nowadays we are mostly issued in fixed form, fixed coupon form, SLDBs. Anything else?
Sir, why is that LIBOR is not available now?
No, because there was a problem. The LIBOR is like there in 2008 and things. At that time, there were 16 AA rated banks in London. So how they fix the LIBOR rate is for each tenor overnight, one week, 2 weeks, 3 weeks, 1 month, 3 months, 6 months. Likewise, for different tenors, those 16 banks have to give an interest rate, in a set of interest rates for each tenor, saying that this would be the interest rate if I am going to borrow at for this tenor, say for 2 weeks, this is my interest cost that I have to tell that as a AA rated bank in London market. So there were 16 banks. Then what do they do? They collect all those rates, 16 rates, and to avoid outliers, they drop down the lowest 4 and the highest 4. Then they are left with another 8, if I remember. They either they drop 2 from the top and 2 from the bottom and take the 12. I think that's the way. However, they do that. Then calculate the average. That would become the LIBOR rate. But these rates are just quoted rates by the parties themselves. This would be the interest cost for me today if I am borrowing at from the market for this tenor. It's not a rate that they have traded. They have borrowed actually. That's a one thing. It's not a price that they have traded. The second thing is during the financial crisis or that time, LIBOR becomes a benchmark for most of the transaction in the world. The same set of banks, they might have entered into different type of transactions, and depending on the fixing dates of these interest rate for these transactions, they try to manipulate it in their favor, because it's not a traded price, it's just a quote. They assume that they can borrow at this rate, so they try to indeed they manipulated that rates in their favor. So even officers from Bank of England, there was an involvement in that process. So therefore, the regulators, they decided to ban this, and from 2022, if I remember correctly, they are going to stop the use of LIBOR and move into more market-oriented benchmark rates based on the rates which are actually traded in the market. The benchmark rates would be decided, but now the thing is, if it is based on the market rates, then it would be somewhat difficult to quote a price for the future, because all the rates that we traded are sort of for the history. What would be, what is the 3-month interest rate as of yesterday? What would be the interest rate as of today? It is difficult, some difficulties in that. So, but there are few candidates now in different countries. For US, what is the rate that they are going to use, and even for UK pound, they have some candidates identified. They are testing with those things, but still they have that uncertainties or the problems. But somehow they will come up with a solution and replace LIBOR with some other benchmark rates. That's what happened.
So who is the regulator? Is it BIS?
Sorry?
Who is the regulator for this? BIS? International Settlement? So,
BIS? No. That's I mean, regulator means say Bank of England, and they had a financial supervisory authority, FSA, in UK, and US Fed, and on these countries, central banks and other financial regulators, not the BIS.
okay. The other thing is Sri Lankan developments can be bought by anyone, or can be bought by the primary dealer?
Auction through the primary dealers again, but if you have foreign currency inflows, you are supposed to, or you are allowed to keep foreign currency in your position, then you can invest.
So the foreigners also can buy from the primary dealers.
SLDBs, I'm not sure whether foreigners are allowed.
Okay.
I think only for residents.
So I have a question. Instead of LIBOR, LIBOR rate, can we use USD prime rate as the benchmark in monitoring purpose?
What do you mean by prime rate?
USD prime rate, that is for Treasury middle office monitoring purposes. Can we use that as a benchmark? rate?
USD prime rate.
Yeah, USD prime rate instead of LIBOR.
From where do you get it?
In the net, we can get the rate numbers.
The net means in the internet.
Yes, yes.
But there should be the issuing party, or the source would be a reliable source. If it is a reliable source, yes, you can use. But the tendency is to get the SOFR now, secured overnight funding rate in US. So basically that depends on the repo transactions in the US market, overnight repo. That's why it says secured, because repo you get the collateral. Secured overnight funding rate, SOFR. That's the, for the time being, I think that's the best candidate they are considering. The second, but that's the problem. That is only for overnight. Then what are we going to do with the 3 year, or 3 months, 1 week, or 6 months, 1 year maturities? Those are the issues they have. But I'm not sure the prime rate that you are talking about, if it is a reliable rate, and if you think it reflects the market, that can be used. But sooner regulators will come up with proper benchmarks.
So from where can I find SOFR, sir? Secured overnight funding rate?
It should be available in Bloomberg, Reuters, or even maybe, I'm not sure. I have not tried. Maybe in the or in the Fed website, probably.
Okay, sir. Thank you.
Anything else?
Sir, you said SLDBs could be purchased by who hold USD, I mean foreign currency account, or they have, if someone is having foreign currency.
Yes.
Exporters.
Exporters. Yes.
Importers.
There's a eligibility requirement in the. So yes, you can get it. See. .05 is the rate for the last week. SOFR, secured overnight financing rate. It's from the New York Fed. If you want to know more about SLDBs, just visit the central bank website. You can find out, and there are press releases whenever they announce it to the market. It will give you the summary. Shall we move forward? Or do you have any other question? Any other question? If not, I'll move forward with the bond auctions. So auctions, again, there are slight variations in auctions. Here we are going to discuss about the auctions, types of auctions which are related to bond auctions. So basically, auctions can be single price or multiple price options. That means at the end, the winners, whether they will get the bond at a single price or different investors will get it at different prices. That's the difference between single price and multiple price. The regular options means whether there's a regular calendar. So every 3 months we issue a 10-year bond. Every month we issue a 5-year bond, something like that. Whether there's a regular calendar of options. That is the meaning of regular options or ad hoc options. Whenever we need, we conduct an auction. We don't know whether it's a 5-year or a 10-year, maybe a combination, things like that. So in that sense, in Sri Lanka, I would say we have a ad hoc auctions. Though we have auctions, what is the auction date is regular. We know that it is not sort of regular auction. In a regular auctions, if you go and visit the Fed website, they might have said what frequency they issue 10-year bond, in what frequency they issue 5-year bond, in what frequency they issue 2-year, 30-year, things like that. So you know in advance what are the auction dates and what is the tenor of that auction. Only the coupon will be changed depend to the market requirement and the issue size. So that's the difference between regular auction and the ad hoc auction. The difference between single price and the multiple price is it can be even ad hoc auction. It can be either a single price or a multiple price. Single price means all investors will get it at a single price. In the multiple price, different investors will get the bond at different prices depending on their bid prices. Then the tap system is, so this is, though we call it a primary, yes, sort of primary. This is a bond which is already in the system, already exists. Say government of Sri Lanka issued a 10-year bond in January 2021. In the tap system, either they can keep it open for another 1 month or a 2-month period. Investors can buy it, or from the like through a bidding process, or on a particular day, the issuer can announce another auction to issue more on the same bond. That is, we call it as a reopening as well. Already existing bond, the issuer issued more bonds on the same bond. That's the tap system or reopening. There can be a slight difference between tap and the reopening. Basically, reopening on a single date, the new auction is issued, but in a tap, it is kept open for a window. The investors can buy it from that through that window. That's the difference.
In a tap system, so you have, say, initially offered some amount, right? So if that amount is not fully taken up, do you keep it open or do you like offer some more?
Both can happen.
Okay. Okay.
So same bond means that it is only have only one serial number. Is it the case?
Yes, yes, same IC, same IC. That means the coupon rate and the maturity date is fixed. Now we know what it is. But say now the issue size is 10 billion rupees. Issuing more bonds, that issue size would go up to maybe 11 billion or 15 billion or something like that. It's not a new bond. with a new maturity date or with a new coupon. It is the same bond already issued and available in the market.
Okay, sir.
Okay. So then we'll discuss about how multiple price bonds or auction work and the single price works. This multiple price, also called discriminatory price or pay as bid auction, because whatever the price you bid, you get it at that price. That what does it mean? Pay as bid. But if you are a winner, remember that if you are a winner, you get or you buy the bond at the price you bid. That's why it says pay as bid. Or means the no uniformity of the prices that investors get. For different investor, different price depending on the bid price that they bid or offer. So in the process, what they do, competitive bidders, they place bid, what is the price and the quantity in a sealed manner. That means it's not available for anybody. Only the bidder knows what is the quantity, what is the amount, or what is the quantity or the amount and the price that they bid for. So then after the cutoff time, bid is closed, then the issuer will open all those bids and decide who are the winning parties. Each winning competitive bidder pays the bid price that she the key thing. The price you pay depends on the bid that you submit. And in some countries, there's a group called non-competitive bidders. That means even in USA, when they issue US treasuries, they allow small investors or small institutional investors to even to other central banks, but small amounts you can buy through this non-competitive bidding process, in which what do you do? The bidder, they specify only the quantity. What is the quantity that the bidder wants to buy, not the price. So once the bidding process is over, the issuer will calculate the weighted average of the issue price. At that rate, these non-competitive bidders can buy the quantity that they have specified. That is the process in a multiple price auction. So competitive bidders, those who win the bid, they will get the bond at their bidding price. Non-competitive bidders, they will get it at the weighted average price. The difference is everybody, all winning bidders pays the lowest bidding price. That's the difference. All others are the same. Bids are submitted on a sealed basis, that or the secret manner. Nobody else can see it, or even the issuer cannot see until it opens it at the or after the closing of bid submission and opens it and decide the price. Until such time, even the issuer does not know about the different bidding prices. Only the bidder knows what is the quantity and what is the amount that they, sorry, what is the price and the quantity that they bid for. Only the bid. So after the cutoff time, again, issuer will open all these closed bids and decide what is the minimum accepted bid, what is the lowest price that we are going to accept. At that price, all the winners will get the bond. That's how it works. Even for the non-competitive bidders, that weighted average price you will get at that price. So it is called single price or a uniform price auctions because everybody gets the same price. That's the key here.
So when you say highest losing bid, what does it mean?
Okay. Yes, it may be both the same or there can be a slight difference. Highest losing mean, so say the accepted bid price is 98. The next one, the losing party may be price it at or bid at 97.8. That's the highest losing.
Right.
The party who lose the bid, but price among the losing parties. In bond auctions, in the uniform price, there's a small variation we call the method Dutch auction. That's the mostly common use method, descending price auction. So in this, we select the lowest winning bid. All the parties pay the price of the lowest winning bid. So among the winners who has got the lowest price, everybody gets that price. That is the lowest winning bid. We call that method is the Dutch auction. So that's what we sorry, this is a very common auction in the single price method. So I'll go through this example and explain both methods.
So in the single price method, a single price, only one bidder is winning?
No. All the bidders who are winning, they get their allocation, but at the lowest price, lowest winning price.
Do they have to accept that?
Sorry?
Do they have to accept that? Or if they have quoted the lower prices than that?
Then they won't be accepted. No, the winning means your bid has been accepted. Otherwise, you are a loser. You bid the price. The seller has not accepted your bid means you are not a winner.
So other parties who have quoted higher prices will be also given.
Yes, they are the winners. The parties who have quoted the highest high prices, they are the winners. But they in the Dutch single price method, even though you have quoted a higher price, you will get at a lower price depending on the lowest exit price.
Okay.
So assume a company wants to sell 10 million worth of bonds. This can be bonds or shares or whatever. So in this I have considered only four bidders, and the first step would be, in any of these methods, sort them out. In the if the bid is on price, sort it on the descending order. That means from the highest bid to lowest bid. What is the highest price? So in this case, I have put in that order: party A 96, party B 95, party C 94, party D 93, and the corresponding quantities. What does it mean? There's a party. That party has submitted a bid to buy 1 million at a price of 96. There's another party. That party agrees or is willing to buy 5 million, but at a price of 94. So that's the interpretation of these two figures. So what the issuer does, first sort them in the descending order of the price. Remember, this is a bond. Even it's equity, definitely there will be only the price. So sort them in the descending order, and in front of that price put the quantity. What is the quantity? That corresponding quantity that the bidder is willing to buy. So the bidder A is willing to buy 1 million worth of bonds at 96. Generally, this quantity is in face value. So 1 million face value bonds, 96. So once we put them in the order, descending order, then what do? We calculate another column or figure, cumulative figures. At this level, cumulative figure is only one, the quantity. When it comes to the second bidder, first bidder has agreed to buy 1 million, second bidder has agreed to buy 4 million, altogether 5 million. Likewise, we keep adding. Now we can see 1, 5, 5 plus 5, 10, 10 plus 3, 13. Likewise, you can keep going. But you know what is the size that you want to issue. It's 10 million. So therefore, no point of going below that, even though there are many bonds. So when you reach this point, you have fulfill your requirement. There are 3 bidders who are willing to buy this bond, 10 million. Okay. So in a multiple price bond, what do? You draw the line here. Sorry, here. This is the cutoff. In a multiple price issue, you draw the line here, cutoff line, and you sell 1 million to party A. You sell another 4 million at 95 to party B. You sell another 5 million at 94 to party C. You have issued 10 million worth of securities. What is your total cost? So the party D and whoever who has submitted quotes below 94, they won't get anything. This is the multiple price auction. each bidder, winning bidder. So these are the winning bidders. These are the winning bidders. They get it at 96, 95 and 94. Is it clear? Is it clear how the multiple price auction work?
Yes, sir.
Okay, then what is the cost? Total cost for the borrower? What is the total cost? $96 into 1 million, 96 million plus, indeed not the total cost, total amount, that this is not the cost because he's the borrower. Total proceeds. Then 95 into 4 plus 94 into 5. This is the total proceeds. You have to divide this by 100 and multiplied by 10 million to get it the total cost, because this is as a percentage. Price is given as a percentage. For a 100 face value, party A agrees to pay 96. That's how. So these things multiplied by 10 million divide by 100. That's the rupee amount that you get, rupee or dollar amount. It should be something less than million. Okay, what is the weighted average price? What is the weighted average price? It is easy for me to use the $96, $95, $94. Is it correct? $96, $95, $94, $14, $145. You get paid. How do you calculate the weighted average price?
The bid
So-
quantity divided by the total quantity, right?
Yes.
Sorry, bid price divided.
You multiplied 96 into 1. Likewise, you do it up to here. Add them and divide by 10. 94.6 is the weighted average price. So if there's any non-competitive bidders, they will get it at 94.6. But yes, I forgot one more thing. If there are non-competitive bidders and the company wants to sell 10 million bonds, first they have to take out the amount that they receive through non-competitive bidders. In a company issue, it won't happen, but only in some government issues that happens. So whenever there's a possibility for the non-competitive bidders, whatever the bid amounts deducted from this, say you have received 2 million of non-competitive bids, then for the competitive bidders only 8 million, then you go up to 8 down here, not up to 10. Okay, for the time being, forget about these non-competitive bidders, but that's how you do. You make adjustment in the issue amount. So now assume no competitive, non-competitive bidders, everything is competitive. So 3 bidders, winning bidders at different prices, and the weighted average is 94.6. What does it mean? Bidder A purchased 1 million at 96. Bidder B purchased 4 million at 95, paying 380. Likewise. So the weighted average is 94.6. So this would become the market price. 94.6 is the market price. So what would happen? Is there any losing party or winning party in this case? Among these three? Once the auction is finished, the issuer will announce this weighted average and the quantity that they borrow. So this is the market price, 94.6, whereas party A has paid 96. So he is losing. The party B, he is also losing, but party C, he is winning because he paid only 94. Now he can sell it at 94.6. Party A, who bought at 96, the market price is 94.6, he is losing. The same thing for party B. This is called this Venus curve exists in the multiple price bidding mechanism. Is it clear?
So can we treat that amount as a single price? That
Yes. Now,
A and B going to be winner.
Market is trading at this price because this is the weighted average cost that reflects the market intention, ultimate market conditions. Otherwise, market cannot take this each price. The weighted average concept is there. But how do we calculate the weight? Price, and price is weighted by the quantity compared to the total amount.
No. Under single price, can A and B can be the winner?
Yes. I'll come to single price. Still, I'm talking about the multiple price method.
Okay, sir.
In the multiple price method, this is the way. Bidder A pays 96, bidder B pays 95, bidder C pays 94. So there can be winners who are losing. On the bid, they have won, but they are losing. But what is the advantage for the issue? If the bidders, they want to get this, they want to be in the winning side, they will try to quote competitively and at a higher price, and not only that, they can get as much as possible from the market, because party A pays 96, party B pays 95, party C pays 94. So at least here even for 1 million, they get something more. The issuer was able to borrow a high amount, but it would not be the case in a single pricing method. Okay, if you go to the single pricing method, if I delete all those things, what would happen in a single price method? Before we move to the single price method, we'll do the calculation. What is the amount borrowed? We'll say amount received basically at this rate 94.6 into 10 million divided by 100. The issuer was able to borrow 9.46 million. The issue size is 10 million. For a face value 10 million bond, issuer managed to get 9.46 million. Clear? Okay, let's go to the table and see what would happen if it is a single price. The procedure is the same and to the point that you decide the cutoff. So you calculate the you arrange them in the descending order of the price, then put the quantities, respective quantities at the front, then you calculate the cumulative amounts. So your quantity is 10 million. At this point you reach it, so this is the cutoff. Still cutoff won't change. Okay, but since it's a single price, at what price will the borrower issue this bond? What is the price? It's a single price. It will be at 90. So this is the price. Even bidder A, bidder B, they get it at 94. Though they have bid it at 96 and 95, they also get 94. Bidder A will get 1 million at 90. So bidder B will get 4 million at 90. So the single price 94. That's how single price mechanism works. Clear? Now you can see the difference between single price or the uniform price method and the multiple price method. Is it clear? Now we'll go and see what is the amount in this method the issuer would be able to borrow. So now everybody pays 94, not 95 and 96. So you can copy this as well. Party A, Party B, Party C all pays at 94, and the bidder will, the issuer will receive only 9.4 million. So the difference is 60,000 less. So in a single price method, cost is high for the issuer. He may not get the quantity the issuer would have got in a multiple price method. If it was a multiple price method, the proceeds of the issue would be higher than to a single price method. What are the advantages and disadvantages? Here, nobody would feel like winner's curse. Nobody would face that. She is happy because that's so market price would be 94. Market price would be now 94 because that's the issue price. Everybody gets it at 94. Weighted average is also 94. So party C is happy. That's his bidding price. He got it. Party B and A more than happy because they were willing to pay 96 and 95, but now they are getting it at 94. What is the advantage for the issuer in this case? So in a single price method, the bidders, they just wanted to be in the winning side. When you are in the winning side, you get the lowest price. So that is guaranteed. So everybody will try to be in the winning side and quote a slightly high price. So therefore, from that angle, disadvantage for the issuer because everybody will tend to price it at a higher price because they want to be in the winning side. Then there's a possibility this closing price or the issue price to go or tend to move in the side. That is the advantage of having a single price mechanism from the issuer's point of view. But on the other hand, the amount that the borrower can get or the proceeds may be less compared to the multiple price auction, but that depends. Say if in this instance, instead of at 96, instead of 1, if that party is willing to buy 5 and this party is 1, then the gap, you can see gap is different. Even you put 5 here and 1 here, there's no difference. This would be 9.4 million, but in this case now it's 9.5. So 140,000 difference. So that depends. So if this is only 0.5 and this is only 3, we put it 1, 3, then the rest is here, then the difference would be low. See, only 45,000. Earlier it was about 60,000. So depending on the way they bid, the difference would be increase or decrease. However, generally that's the case. In a single price auction, the proceeds received by the issuer may be low than a multiple price auction. But in a single price auction, there's a tendency for the bidders to bid at a higher price because they just wanted to be in the winning side. So, and in a multiple price auction, they try to avoid that winning curse. They want to be in the winning side, but very closer to the minimum accepted bid price. So they are not trying to bid at a higher price. They will try to, the tendency would be to quote at a lower rate. So that trade-off is there in between these two mechanisms.
The amount received, can we explain that how that comes?
Sorry?
Amount received by the issuer?
Amount received?
By the issuer?
Yes.
How that amount comes, can you show that?
So because you know what is the price that they are going to pay and what is the quantity. And this is the price is for a bond, it's as a percentage. 96 means for 100 face value bond, price is 96. So when it comes to here, I change this to the original position 1, 4, and 5. 1, 4, and 5. So these are the this is the average price. 94.6 is the average price the issuer gets. So average price into face value divided by 100. That's the amount received. Or you can do the same without doing this. You can multiply this by 1 million. Instead of 1, you can multiply it by 1 million and divide by 100. Then you get 960,000 here. 3.8 million here, 4.7 million here. Altogether, it would be 9.46.
That is because of the face
Million.
value.
Sorry?
That is because of the face value. No?
Yes, the 10 million is the face value. That's the issue size, because always we prefer bonds in the face value. When we say I buy 10 million bonds, that means face value. The price you pay would be different depending on the market price.
So in that case, the single options it's okay, better, very beneficial. That means advantageous for that issue or not. So 9.4 we can buy at 9.4.
Oh, how come?
The space value, although space value is 10 million, so
Hmm.
we can get it at 9.4.
Okay, you are going to issue a bond with the face value 10 million. What do you prefer? To receive this amount or to receive this amount?
No? Okay, sir. Okay, good.
As a borrower, you prefer the highest price, not the lowest price.
Yes, okay.
Clear?
Okay, sir.
Okay.
Okay.
Bond auction. This is not a like a bid for you are conducting a bid to buy something by yourself. If you say your bank wants to buy a building or you want to rent a place to have a branch, then you quote for prices. You prefer to get the lowest price because at that point you are going to pay. You are going to buy that. Then you prefer the lowest price. But in this instance, you are going to borrow, you are going to sell something as the borrower. So you are selling the bond. So then you need the highest price. Clear?
Okay, so clear.
Borrower is the seller. So borrower prefers the highest price in terms of price. That remember that in terms of price. If the bidding process is on yield, then what is the case? Then you select the lowest yield first. So when the price is high 96, yield may be here 2.3. This one yield may be 2.4. This might be 2.45, something like that. Yield increases. That means your interest cost increases as a borrower. So you prefer the lowest interest rate. Lowest interest rate means highest price. So you have to remember that one as well. The price yield relationship, inverse relationship. Is it clear? So we did it, this example, in terms of price. But if it was on the yield, it becomes other way around. Then you select the lowest yield first and arrange the ascending order of the yields. Then you draw the cutoff line. So when you conduct the auction, as I mentioned, one thing is whether it's a multiple price or a single price. Once the auction is over, in the market there will be only one price, the secondary market price. All the buyers face the same value in the secondary market. So therefore, that's why in the multiple price auction there will be that concept called winner's curse. Those who have successful in the bidding process may lose in the secondary. So there can be asymmetry of information in all auction processes. They have their own assessments of the issuer. So each buyer has an unbiased private value of the uniform unknown value they are going to face on the secondary market. So different buyers will have different prices, but when it comes to the secondary market, everything is factored into a single price. Different beliefs and the chances are mixed and come to a single price. So the problem here is from the issuer's point of view, issuer wants to borrow as much as possible, close to, if he can borrow more than the face value, he may be happy to do that. So the revenue maximization is the main concern of the issuer. So therefore the seller must set the right incentives and lower the risk for the buyers. As I mentioned, when the lead manager price it should be fair for the both sides. So seller must give incentives to the buyers not to underbid. Make sure that it's not the bid. That means bid at a lower price. That has to be thought by the seller and give as much as possible in incentives. So then in the markets we see gathering price would be a there's a cost, but still you may not get the all information available in the market. So that information asymmetry that may lead to problems in the market. The pricing would not reflect the correct picture. Briefly, that describes in this in this slide. I think I need not to explain those things. These are not technical. These are just explanatory, self-explanatory things. So as I mentioned, cost of reselling. Some of the parties may lose when they try to resell, especially in a discriminatory price auction, because they are buying the market price at the even at the auction. Auction weighted average is lower than the individual buying price. There definitely there will be a set of investors. Of those, the buying price is higher than the market price. So to avoid that, they will try to underbid it. So for that, to save that, issuer can switch to uniform price auction. In that, everybody will try to bid it, submit a bid at a higher price, because they just wanted to be in the winning side. Once you are in the winning side, you pay the lowest price. So you want to what you want to make sure is you are a one. So then you tend to bid at a higher price. There's an advantage for that to the issuer. Then through the primary markets, they send the signals to the secondary market. Say what would happen the next auction, bid auction, if the interest the yield, weighted average yield is slightly higher than the previous auction, message goes to the market. If it is lower than the previous auction, what is the message goes to the market. So this gives signals. If the whole bond auction is not subscribed or not fully subscribed, what is the message going to the market? If it is oversubscribed, that means for a 10 million size of issue, there are bids for 30 million. What does it mean? There's the appetite to buy this bond. So the demand is high, the price will go up. So all those signals goes through the primary market to the secondary market. It could be a positive signal or it could be a negative signal. This is the one I explained, winner's curse. This is applicable only for the discriminatory price auctions. Winners, they will lose in the secondary market. So basically, what are the repercussions of winner's curse and multiple price options, and what is the impact on the secondary market? I explain here. So briefly, I explain those things when I explain these mechanisms. Only thing I didn't explain. So non-competitive behavior. Whenever there are non-competitive bidders, so they just submit the amount, not the price, but they will get at the market price. That may give or disturb the efficient allocation of resources, or that means funds between investors and the issuers. So that's all about primary markets in bonds. If you have any questions, please ask. So please identify the key differences in single price auction and the multiple price auction. What are the advantages and disadvantages for the issuer and the investor? In both mechanisms, there are advantages and disadvantages compared to the other.
So in central bank, what method we follow?
We follow multiple price. Anything else?
Sir, can I ask a question on the assignment today?
Yes.
Yeah,
It's due today.
Today is the last day, I think.
Yes.
Yeah, there are 3 parts. Out of it, the first part is okay, boss. The second and third, they're asking about the organizational structures required to administer the exchange rate and the reason for failures if abandoned. And the third part is further discuss the impact on monetary policy independence and sustainability of and suitability of different regimes for the developed countries. Could you please elaborate the second and third part of the question, sir? If you don't.
So, will it helpful now? Perfect timing. So, I explained this indeed. I think the week after I issued this. So the basically for some exchange rate regimes, you need some authorities or the institutional setup to maintain that whatever the regime. So what are the institutions that you need to do that? What other resources, and whether what would be the impact on the monetary policy on that system? You may not be able to maintain independent monetary policy in some of these regimes. So those are the things that you have to discuss in second and the third part. And the suitability. Some of exchange rate regimes may be suitable for developed countries, but it may not be suitable for developing countries. There are arguments likewise. So that's what I need. But if you have gone through this, read enough about all these regimes, I think you should have come across these things now.
Okay, thank you.
Okay, thanks. I cannot explain more than that. Then I am telling you the answer. I can say this regime, you need these institutions, and you face these problems. Then that's the answer. But try. I don't know now. You have time. Whether I'm not sure. That's what I said. This is perfect timing for that question. If you study for different exchange regimes, you need some institutions set up in the country. Different institutions. So what are those? What is the role of those? And what are the implications on the monetary policy. But still with those, can we follow that monetary policy? Sorry, not monetary policy, that exchange rate regime. Some of them were already abandoned. Why? What are the failures? Why we cannot use that? Things like that. Anything else? One more thing. I think it's already uploaded. These types of bonds. I just uploaded, thinking that I'm not going to discuss this, but you can go through and get some idea. Different words that we use in the market. And have some idea about those bonds, but I'm not going to discuss this in detail in the class. I think you can go through that and get that knowledge. So I will next week I'll discuss about this floating rate notes. There are few key concepts in this floating rate notes when we discuss swaps and some other products. So that therefore we'll discuss this in detail and move into the next topic. Anything else?
So do we have a group presentation in future?
That's very difficult to answer, because that depends on the situation. This what would happen to this pandemic situation if we cannot come to a single place and do this. It's not possible. Even online, I don't know whether you can conduct a group presentation online, or if you can, we can form the groups. Then if you can discuss that and prepare the presentation and do it online, if you think it's possible and viable, then we can do that. Otherwise, it would be I think impractical thing to do. So let's see the next assignment, whether we are going to give it as a group assignment or again an individual one. I know that the thing is, if it is online group assignment, so some of you feel it's unfair, because I know even in a physical form, some members in the group, they try to become free riders. Then the group leader or the other team members, they fall into a dilemma like, so should I reveal this or not? Because we are all human beings. No, we thought think in that line also. Because of having free riders in this environment, this online environment would be much high. So I think you will agree with that. So that is something that you have to think about. When there are 10 people in the group, only four work towards the presentation and for the report, and other 6 are trying to become free riders, and for your good work others get in mark. It's not fair. I don't want to do that, unless if the group leader or someone can tell only these people contributed properly and others didn't. I don't know how much. So I have bad experience. the cost of that of one of the group leader is the life of his father. Can you imagine? That is how our people behave these days. And then not the last 2019 that happened. And not only that, even with that, so for the preparation part, due to the commitment towards this preparation part, that guy couldn't take his father to the doctor. So then he passed away on that night. Even with that funeral works, that leader had to come to the IBS and hand over the assignment on behalf of other group members. None of others were not in a position to do that. That's what happened. So that's our society nowadays. So in an online environment, I don't know what would happen. So there would be a lot of free riders. I hope you are not that sort of people, but so I don't that much believe on group assignments there. But if it is a physical environment, we'll try to do that because we want to improve your not only the technical knowledge and the other skills, at least by small amount. So that's why we have put it in the syllabus as it is a group thing. If you work it or use that opportunity, you will get to know a lot from different people, because different people have different information set, knowledge, abilities. So you can blend them together and come up with a good product. Your knowledge will enhance, but you need the so individually you have to commit towards that. So without just targeting whatever the 10 points or 10 marks that you will get through the presentation, and try to get it at the cost of the others.
So if we receiving maybe a group or individual, when can we expect that assignment, next assignment?
I think there was a schedule I have given to you. However, mostly it would be either when you are discussing ALM, asset liability management, or just after that, because we want to cover those things, the whatever the fixed income securities that we discuss, and we are going to discuss derivatives in the next topic. Probably next week we'll start that, and the ALM we want to cover those things, and if possible risk management part as well. So more closer to the end, that depends on the phase that we move. I plan about, I think, 6 weeks for derivatives, another 3 or 4 weeks for ALM. If it goes smoothly in that schedule, so at the end of ALM, that would be the release point of the next assignment. Closer to. So maybe 10 weeks, 10, 12 weeks down the line, that may be the target.
Thank you, sir.
But say if you have any concerns, like say for a particular period, I don't know, this won't applicable this you have a plan to travel abroad or something like that, pre-commitment things, whatever, better to inform before we announce all those things. Then we can think about it or try to do adjustments. Once we announce it, we can't do that anything.
So when is the exam? Is there any exams?
Sorry?
Is there any exams? I mean, you're going to conduct. I mean, when is the exam?
Exam is at the end. Definitely, there's an exam.
Okay.
Probably at this phase, I think we can
have an exam, no?
finish before December, so we would have the exam around December. But again, that depends on this pandemic situation. Even we couldn't still have the exam for the previous batch.
All right. Okay.
They don't allow people together from all over Sri Lanka. That's a
okay, sir. Thanks.
Okay. Thanks. Thanks. Anything else? So if you don't have anything, we'll stop here. And we'll start with floating rate notes next week. And I'll start derivatives with that. Yes. Or else we can have another session on yield structure or the term structure of interest rates, but I'm thinking whether you need that or that's what. Okay, I'll think about it and come back. However, next week we'll start with floating rate notes. Then we'll move into derivatives. Okay, then see you.
But in the assignment, the number of words there can be slight changes. Right?
Sorry.
In the assignment, number of words.
Yeah, have I mentioned the maximum?
Yeah,
it's the maximum, no? So better to. It's not very strict rule. It's not a very strict rule, but try to be there. But the thing is, say, when I ask you to write say using 2,500 words, if someone has given the same information or more than that using 5,000 words, just because of he has explained more, I cannot give more marks to him, because if you write 10,000, you can explain a lot. If you write it in 2,500, there's a limit that you can do. So that's what I expect. So even though you write a report on 10,000, you won't get that much for that additional 7,500 words. Okay. Anything else? If not, so we'll stop here. I can see people are leaving now. So we'll stop here. Thank you.